Hey there, I'm Bobby Jones, a retired CRNA turned apartment investor. I'm also the founder of On Call Capital, an equity firm that seeks to educate fellow healthcare providers and working professionals about alternative investments while also providing you with opportunities to invest in them. Now, most of you watching this have heard me talk extensively about apartment investing in my other videos. However, you may not be as familiar with self storage investing. Today, I'd like to change that by discussing the similarities and differences between investing in self storage and investing in apartment syndications. The first thing that you need to know is that both are great options for investors to diversify outside of the stock market. Each type of investment has unique qualities that seek to provide stable returns for investors. You can invest in both as part of a syndication, which is just a fancy term for group investment. A bunch of investors pool their money together to purchase all kinds of real estate, with apartments and self storage being two of many different types. Now, when you passively invest in a syndication, you are investing in a company or team of individuals who are purchasing an underlying asset and carrying out a business plan to improve the value of that asset over a period of time. This is the type of investing I'd like to focus on, since those are the types of offerings that I provide to investors with On Call Capital. Now, just as there are different types of apartments out there with various class, unit, and amenity mixes, there are several different types of storage units. Drive-up units are what folks usually think of when they think of storage units. There are rows of storage buildings with doors that roll upward to the top of the structure. They're usually located on road fronts, and they maximize accessibility for customers who frequently need to access their units. Security measures can vary, but they tend to be the cheapest option due to minimal costs, maintenance, and staffing. Climate controlled storage has grown in popularity over the last few decades. These types of units are used to store items that must be protected from extreme temperatures and humidity. Think of things like furniture, documents, family heirlooms, and even classic cars. These facilities can charge a premium due to fulfillment of a specific niche in the market and services and security above and beyond the standard drive-up facility. Vehicle storage facilities cater to folks who have a car, boat, RV, or other vehicle that they need to store. These places are often, but not always, outfitted with climate and temperature controls. They may be located near harbors, racetracks, airports, or other places where the specific vehicle being stored may be used. Mixed use storage is a trend that's gaining in popularity. This type of storage simply combines storage space in a building with other retail or commercial businesses. There's a building space here in my town that comes to mind. There's a Total Wine and More and a Chef Smart on the top level, and then there's a climate controlled storage facility that's in the bottom level. As more retail space is available for cheap, we're seeing more and more of these spaces converted into storage facilities. Now that you know more about the different types of self storage, let's get into some of these similarities and differences. So, first, let's see what's different. Minimal infrastructure is needed for self storage. You don't have to worry about large plumbing systems like you do with apartments. Sure, you need lighting and good security systems, but mechanical and fire protection requirements vary based on the content that's being stored at specific locations. Precise environmental controls may be necessary, but the higher monthly rents more than make up for the more expensive install of those types of systems. Good management is easier to find for multifamily versus self storage. There's simply more money to make for management teams in multifamily, and that creates a greater supply and demand dynamic. In contrast, self storage usually requires a single trustworthy property manager who can work with minimal oversight. Getting and keeping good management is a significant challenge in the space, with many owners choosing to self manage instead. Tenancy structures can differ dramatically for apartments, with most places offering leases that are 12 months, 9 months, or 6 months in length. This provides a level of income stability for apartments. In contrast, self storage is typically month to month, with people constantly moving in and out of the facility. Now, this continuous turnover requires active management to continue to keep that occupancy high. Tenant rights are very different for the two investments. For apartments, a landlord must comply with local tenant regulations, which vary tremendously from place to place. Evicting tenants can be expensive and time consuming. Now, storage units just don't have this concern. By law, the storage facility owner has a lien against all personal property that's stored in their space. So they can sell, move, or dispose of a tenant's property if that tenant fails in some obligation of the lease. Return structures also vary between the two. Apartments typically have a higher net operating income than self-storage units, resulting in higher prices for multifamily and higher potential upside on a sale. But don't think that self-storage doesn't punch back here. Simpler buildings for self-storage means that fewer things can break, with lower costs to actually maintain a property. Self-storage can produce annual rent that is similar to that of apartments while costing much less to operate. Now, this can translate into higher cash flows and return on investment for self-storage versus apartments. Of course, all this varies significantly based on the financing of any particular deal. So, what are some of the similarities? Well, apartments and self-storage each show incredible economic resilience. In a downturn, there's always demand for workforce housing as folks will shuffle up and down in class based on their economic status. Self-storage is similar in flexibility. During economic upturns, residential sales increase as homeowners move into nicer homes, creating a demand for short-term storage. In a downturn, self-storage experiences even stronger demand as folks choose to downsize or rent and need a place to store their items. Now, each investment also has a very flexible business model. There are several tiers for quality of multifamily. Apartment owners can charge for covered parking, on-site storage units, utilities, and various amenities like Wi-Fi or cable. They can also save money with more efficient operations and unit charge changes like low flow shower heads or LED lighting. Self-storage owners can also choose to focus on different revenue streams, such as U-Haul truck rentals, RV parking, using units as temporary office space, and retail of moving equipment like boxes, tape, and locks. Now, tax benefits are a big deal for both of these investments. Both of them are considered commercial real estate transactions, and both have tremendous tax benefits as a result. Just like with an apartment building, you can perform cost segregation analysis on a self-storage property that allows you to reclassify 30% or more of your cost basis to a shorter depreciation class. Land improvements such as paving, curbing, site lighting, storm drainage, fencing, and landscaping all apply, as do personal property such as signage, security systems, certain floor coverings, and special climate control systems. The list can get extensive, which translates into huge paper losses for investors to claim when it comes to tax time. Now, the markets and positioning matter for both. A thorough understanding of local market dynamics is key to any success that you hope to have in real estate. Both investments should be in communities with increasing populations and increasing economic viability, as well as having the right mix of units and amenities to meet the demands of the community around them. Both apartments and self-storage have similar break-even points of between 60 to 70% occupancy, meaning that each has a built-in hedge against a downturn. Those economies of scale are really a wonderful thing. Both apartment investing and self-storage also aspire to occupancy rates of 90% or higher, which produces great cash flow for investors and operators alike. Now, as you can see, there's a lot to like about investing in apartments and self-storage. Both are stable real estate investments that increase in value over time, providing stable cash flows, tax benefits, diversification, and overall returns to investors. Now, if you found this information helpful, please give me a thumbs up and subscribe to my channel. If you'd like to learn more about investing in self-storage, stay tuned to my show, the Plan B CRNA podcast, where I'll be diving deeper into the self-storage rabbit hole next week. If you have questions or comments, please comment below. If you're interested in getting access to passive real estate investment opportunities, you can reach out to me here or on Facebook, LinkedIn, or Instagram, or my website at www.oncallinvestments.com. Thanks for watching, and I'll see you on the next video.